Okay, so let's have a look at the 2005 incomplete record. I think that year it came up as a type A. So the main difference between a type A and a type B, your type A will look a bit like this here, and the main difference is for a type B you'll have a piece of information here telling you that the gross profit is a certain percentage of sales. So that's your type B, where you work backwards. You do your balance sheet first, get your net profit, and then you use your net profit, then work backwards up with your profit and loss account. With your type A, you're going to use the 10-step approach. So the 10 steps that we're going to look at are going to be these here. So the first one, prepare a statement of capital. Second, prepare debtors and a creditors control account. Your third step, prepare a cash and a bank account. Your fourth, calculate your total sales. Step 5, calculate your total purchases. Step 6, do any adjustments for any loans or investment funds that you might have in the question. Step 7, make adjustments for other gains and expenses. Step 8, make adjustments for drawings. Step 9, prepare your profit and loss account. And step 10 then, prepare your balance sheet. So there's your 10 steps that you need to know for this question. So it's a nice question to get. If you get to type A, you should learn off the 10 steps and then do the steps 1 to 10 as you answer the question. So with this one here, I'm going to have a piece of information to start. So you purchased a business for $195,000, consisting of the following tangible assets and liabilities. So we have to identify from this first paragraph which ones are your assets, which ones are your liabilities, and then the difference between the two will be your goodwill. Let's go through each one of them and see whether they're an asset or liability. So your premises is an asset, your stock is an asset, your debtors is an asset, 3 months premises insurance prepaid, that's an asset. Trade creditors then is a liability, and wages due is a liability then. So what you do is you put them into a simple account like this, listing all your assets, and for each one, get your total. List all your liabilities. So you've got 2, get your total. So your total assets, you're going to take away your total wage or your total liabilities. That's going to give you the worth of the business. And then how much you paid for the difference between the two is going to be your goodwill, and that's going to go into your balance sheet as a fixed asset. So our net worth, 174,660. The amount we paid for it was 195,000. That's taken straight from here. You're going to take one away from the other, and the difference then is your goodwill. That goes into your balance sheet in your fixed assets. That's step 1, 2, and that's step 1 completed, and then we get ready to move on to step 2.